thanks everyone for joining into this Twitter Spaces that we do every week, Wednesday evenings. Very happy to have with me today Siddharth Srivastava. Siddharth, as some of you may know, has been there as part of Mirae Asset Management. He's got with him experience of more than 10 years. He's been someone who heads their ETF products as a category, and he's been looking at such kind of passive investment strategies as they call it, and we'll deep dive into those much more in detail today. So, uh, thanks, Siddharth, for joining in, and glad to have you on our Spaces call.
Thank you so much, Shobit, for having me here.
Okay, Siddharth, let me get going with the basic question. You looking at ETFs as a category for the benefit of our listeners. If you could start with explaining what exactly ETFs are all about. Mutual fund industry per se is good at coming out with acronyms. We know how successful SIPs have become. So, uh, how do you explain ETFs and what is in its store for investors?
Yeah, so I think I'll try to keep it as simple as possible. ETFs are a type of mutual fund whose job is to replicate the benchmark returns by investing in the stocks which are forming part of the index. So, for example, a purpose of Nifty 50 ETF is to generate returns which are generated by Nifty 50 index, which we all see on a daily, yearly, uh, long term, short term basis. By investing in those 50 stocks which are forming part of Nifty 50 in exact same proportion. A very quick differentiation between an active mutual fund, or let's say a large cap active fund, or an ETF, a simple ETF like Nifty 50 ETF will be that large cap active fund will, there the fund manager will try to pick up stocks based on certain parameters, based on his style, out of top 100 space, and in effort to try to outperform the market. Now, in that effort, he or she can succeed also or fail also. He can outperform index market by 1 to 3% or underperform also by 1 to 3%. Whereas a Nifty 50 ETF, which is a passive investment, is basically not taking all those calls and simply trying to replicate an underlying index. Now, for an investor, ETFs are a very powerful tool to form part of their portfolio. Now, while I'm taking Nifty 50 as an example, and I think a lot of audience will already know about Nifty 50, Sensex, Bank ETF, but then there are several categories of ETF which provides you more opportunities to take exposure in certain countries and in very specific themes and sectors, in certain strategies, etc. So ETF as a concept has evolved from simple market based investing like a Nifty 50 ETF or an S&P 500 ETF, and it has evolved to much more.
Okay, I think that's pretty straightforward. So tracking markets and just tracking the index. So pick an index and you can invest into an ETF of that index is how I will understand it. Uh, so in this situation, Siddharth, you spoke about uh, the comparison with active funds. Industry per se has seen generally active funds making great returns. We keep hearing success stories of people starting their investment journey 10 years back, 15 years back, and having compounded their wealth. Uh, why, from a investor standpoint, should he consider the ETF? What are the key advantages that you think an investor can draw out if he considers ETFs versus these active managed funds by its fund managers that people know of, have seen them deliver returns. So, how do you really uh, comment on that?
Okay, I think this is going to be a long answer. So, basically, why passive investing became popular, or we can call it index investing or benchmark investing, simply trying to replicate a benchmark. Why it became popular? Because globally, it was found that yes, active mutual funds try to generate alpha, but a lot of them are not able to generate alpha, or in a simple language, are not able to outperform the market. So then the question came, why take the fund manager risk, or why pay so much of expense ratio when they are struggling to outperform the market, and that too, especially on a consistent basis. So that was the thought process behind the sorts of beginning of passive investing. In India also, as markets become more and more efficient, there are more and more players which are there. There's more information available. I think I can find out balance sheet or cash flows or earnings growth projection of a company as quickly as a fund manager can. And I think a lot of investors with a lot of tools available can also do that. So point is that information gap is getting less, and because markets are so efficient, it becomes very difficult to generate alpha, and that to generate alpha on a consistent basis. Having said that, I'm not saying that there are not fund managers who generate that alpha, but it has become difficult now. Now the reason why investors should invest in passive funds or ETFs are, I think, twofolds. One, where they are seeing that alpha is shrinking, they can simply pick up these low cost products and just simply get the market returns uh, without the fund manager risk and without facing the cycles where fund manager style is underperforming the market. So while it may not sound attractive enough, but I think beta itself is very strong in India, right? If Nifty 50 is generating mid-teen returns, and you are seeing on a 3 year or a 5 year basis 80% of large cap funds or 70% of large cap funds underperforming Nifty 50, I think a beta story itself is very strong. If you are able to capture those market returns at such a low cost, it's a very powerful tool, and I think people can add these ETFs in their core portfolio. Now, the second reason why people can think about adding ETFs is basically after categorization of mutual funds, there is very less product innovation which can happen on the active side, whereas on the passive side, which is the ETFs and index funds, a lot of product innovation can happen. And we are seeing a lot of products which are being launched, for example, which capture artificial intelligence theme or electric vehicles ecosystem, or you have low volatility based ETFs or a quality based ETF. You have momentum strategies running on mid cap and large cap segment. So all those options, and then you have also like IT sector ETF or a bank ETF or a consumption ETF. You have all those options also available which are not there on the active side, and there here investor can simply choose pick up these products, take a tactical call if they want to basically invest for a short term, or even can do a long term investing in these products where option is only available on the passive side. So we always talk about core investing, we always talk about active versus passive, and you should invest passive because active are not able to outperform. Yes, all that is true, and you should obviously make certain passive funds as a part of your core portfolio. But then there is world of opportunity which also lies which is provided by these exotic and innovative passive products, which can add uh, returns or reduce risk profile of your portfolio.
In fact, Siddharth, I can relate to it when you are saying it. I can distinctly remember a phase between 2015 to 2018, 19, I think. I was invested in this one particular fund, and for almost about 2 years, the fund manager was quite, it was visible from the holdings, he was quite bullish on uh, certain set of themes which he was consistently holding as his top holdings. And I think almost after 2 years, I realized the fund had underperformed uh, Nifty in that case as a benchmark by about 3%. And I thought I had given it enough time. 2 साल हो गए अभी भी अंडर परफॉर्म कर रहा है एंड आई लुक्ड अप some similar kind of funds, and I moved from that fund to the other fund. Now, as luck would have it, uh, another 1.5 year later, I realized that the fund that I had moved into ended up underperforming by almost about another 2.5% to the benchmark. So almost after 3.5 years of having invested into two of the reasonably, at that time when I was making the decision, the funds which everybody was talking about, I realized I was, not even generating returns equivalent to market. And of course, it wasn't the best feeling to know that I could have generated at least equal to market, leave aside 3, 4, 5% better than the market. And I got really excited about such kind of index funds at that time, where I decided that a part of my investments, I don't want to have this feeling कि at least market जितना return भी नहीं बनाया, and I decided to move part of my investments into those index funds, at least to ensure that for X part of my portfolio I generate market return. So I can completely relate to that point of yours, and I think it does make sense for people to think about these kind of ETFs or index funds to ensure that they generate the market return. Uh,
I think that is very important point, Shobit, because we also did a study, I think, last year, and we looked at large cap funds performance in previous 5 calendar years. The reason being that people typically, by habit, pick up funds to invest in based on past performance, right?
hmm,
And when we looked at performance, there was not even a single fund which was consistently in quartile one in all 5 calendar years. There was just, I think, one fund which was in quartile one in 4 out of 5 calendar years. Such is the churn in the performance also. That fund which is performing better in last 1 2 year uh, may probably move to quartile two or quartile three. And if you have invested by looking at past returns, your ultimate experience out of that fund may be very below your expectations and below the market returns. I think one very interesting stat which we also pulled out recently, and one thing which you say is that a section of your portfolio can be based on passive fund, because then you are sure that you are able to generate market returns from a certain portion of a portfolio, and the remaining portfolio can be based on fund manager who you believe in, and his style may eventually perform or will perform, etc. For example, we were looking at this data, Shobit, and this is October 5th ending data. Only one mid cap fund has outperformed Nifty Midcap 100 index in last 1 year. And this is the bull run we are talking about.
hmm.
Only 4 out of 23 small cap funds have outperformed Nifty small cap 250 index. And this is mid and small cap category we are talking about. People think that in a bull rally, it is easy to generate alpha, and and obviously passive investing doesn't make sense, especially in bull market or in mid and small cap. But data obviously says something else.
In fact, I was going to ask that question, that are there times that index funds make more sense, and you sort of preempted that question. So what you are saying is it is not necessary that only when markets are not doing well that you think of saving cost and going to ETFs or index funds. Even in good markets, people should consider these as part of their portfolio allocation.
Interesting. I think people should, while we are talking about performance and comparing performance, people should not simply get stuck into active versus passive. Like you said, they should try to create a robust portfolio with active and passive funds. And if you choose good fund managers and good active funds, and with some amount of investments in passive funds, then your portfolio will be very robust. For example, uh, in before COVID, there was a time when only top 10, top 15 stocks were performing, right? The top Nifty 50 stocks. And there the typical reply was that this is a very concentrated rally, and that's why large cap funds are underperforming, and that's why ETFs are doing well. But when after post COVID, there was a significant recovery, large cap funds still underperformed, right?
Hmm.
Surprisingly, now in this bull rally, when you expect mid and small cap to funds to generate higher alpha, that is not being the case. But Shobit, you'll be surprised to know on the contrary that out of 22 large cap funds, 13 have outperformed Nifty 50 in last 1 year. So if I'm looking at just 1 year data, contrary to all the previous data, it is actually small and mid cap funds which are struggling, and large cap funds are still doing okayish. I'm like 50% of them are outperforming Nifty 50. So I think rather than timing the market or timing whether you should invest in an index fund or an ETF or an active mutual fund, the focus should be to just create a robust portfolio where a section of your portfolio is in active and a section of your portfolio is in passive.
In fact, what you said on concentration reminds me of that fact, and I would often quote it saying that in some manner, Index is an auto selection fund manager. It's a rule-based fund manager. It is not somebody using his intelligence, but as you rightly said, the reason that those top 10 stocks were there were because they were the ones which were continuing to deliver, and they automatically continued to get higher and higher weightage in the index. And stocks which may not have performed automatically on a regular interval, either 3 months or 6 months, would have kept getting knocked out of the index. So good performing stocks automatically become part of the index, and maybe the not so good performing ones or the ones which market is not rewarding will automatically go out of the index. So it is like an auto rule engine which is working for you.
Absolutely.
So at this point of time, Siddharth, let me actually ask you, since you said this is a good way to create a robust portfolio. Just I thought it's the right time to ask, how should people really go about investing into such kind of ETFs or index fund? It's just more to simplify it, because people know how to go about investing into a mutual fund. But when you say ETFs or when you say index fund, is there anything different? What are the nuances? What could be the costs that one should know about, etc.? If you could just detail that a little bit for us.
I think ETFs should be used to, first of all, be part of your core portfolio, especially on the large cap side. And obviously, how much allocation on the large cap will depend on the risk profile of an investor. If an investor is very risk averse, let's say within equity 90% large cap, if someone is has reasonable risk appetite, then 20-30% of mid cap and small cap can be there. Otherwise, if you have significant risk appetite, you can even go up to, let's say, 50% of mid and small cap, allocation remaining being the large cap if I'm talking about domestic equities. Now within this allocation, within the large cap space, I think a significant portion can be allocated towards ETF like Nifty 50. I think that should be the starting point. People should first, before trying uh, factor based ETFs or very exotic ETFs, they should first start their journey in passive investing by investing in, let's say, a simple Nifty 50 ETF or a Sensex ETF or a Nifty 100 ETF. Increase proportion within large cap space. I think you can have a 50-50 allocation towards a good one large cap active fund and a one Nifty 50 ETF. Now, even in the mid cap space, while conversation has always been about that mid cap and the small cap will generate alpha, even within mid cap space, if you look at fund performance, it is very cyclical. And again, a lot of them are struggling to outperform the benchmark. So even within mid cap allocation, I'll say that pick up a ETF or a index to take the exposure, and certain amount of mid cap exposure can come from active, whether you do it using, let's say, a multi cap fund or a large and mid cap fund or a standalone mid cap fund. That is your choice. Now, let's say, if you want to do international investing also, and let's say 5 to 15% of your portfolio, 20% of portfolio, you want to invest internationally, then I think that should specifically be through passive, because you get a more targeted exposure, more transparent exposure in markets you are basically trying to take exposure. So it also reduces the overall cost of your portfolio from a TER point of view, reduces the fund manager risk, etc. So I think this is how people should go about and construct their portfolio. I think only passive is not the answer, only active is not the answer. Pick up two, three, or three, four good active funds and combine it with two, three passive products and create a robust portfolio.
Actually, what you said about international investing also rings a bell. Ki, suppose I know that there are good tech companies in US and I want to have exposure to the likes of Apples and Googles and Microsofts because we use all of those on a day-on-day basis. And natural tendency, familiarity, you think you should have exposure. So rather than going and finding which is the best fund manager to play these US tech companies, it's just easy to just buy a US NASDAQ fund. And that, in a way, is similar to the index investing that you're talking about. That's how I'm thinking about it when you said that.
Correct. Absolutely.
Uh, Siddharth, in all of this, just also curious to know, uh, do international investors also look at, or how is this whole category of passive and ETF looked at from international investors' perspective? We know a lot of FIs when they come into India end up investing into Nifty. So in some manner, we know how institutional investors think, but uh, what is the market landscape when one talks about such kind of investing in, let's say, other advanced countries where they have gone through such cycles of maturity, where the asset management industries have grown multifold in the same journey as India is growing. So, how there such kind of products are offered, and what kind of choices investors make? If you have some thoughts, if you could share.
Yeah. So basically, ETF market globally has grown significantly. We are, in a way, from an allocation point of view, are, let's say, 10 years behind where the developed markets are in terms of understanding how to use ETFs in portfolio. Total AUM right now is north of $10 trillion, which is more than three times the size of India's economy. And as expected, most of the allocation is towards simple market cap based indices. For example, S&P 500 base ETF, Nasdaq 100 base ETF, and then you have obviously ETFs based on global markets or regions like emerging markets, based on MSCI India or MSCI emerging markets, etc., where people try to take market cap based exposure towards one's own country and then towards other markets, like how we are trying, how we are keen to take exposure towards US tech market or US market as a whole. The second very prominent category is smart beta ETFs or factor ETFs, which as of end of May was, I think, more than $1.3 trillion. So almost 15% of the market is in smart beta products, where you get products which are targeting certain performance behavior like momentum, low risk, quality, high dividend, etc. And people basically invest in factors which they want, right? Behavior which they seek. Then I think bond investing has also picked up quite well in last 1 2 years. I won't go into active ETFs because that is gaining a lot of popularity globally now, but that's a, I think, separate topic. But apart from that, I think if I have to pick new trends, Shobit, and because Mirae Asset has a very strong presence globally in ETF segment, what we are seeing is rise of thematic investing. As you might be aware that there are a lot of new themes which are emerging, like artificial intelligence, electric vehicles, renewable energy, semiconductors, etc. So instead of market cap based investing, people also want to take exposure in these themes if they believe that this is a long term story, and this particular segment will do well. And lastly, people have started to use ETF as a strategy also. So, for example, if you are, let's say, a bit concerned about the market, why not invest in a covered call ETF? Or if you want to take a bearish position, why not invest in an inverse ETF? And if you are too bullish, why not invest in a leverage ETF, which gives you, let's say, X times of return what market is giving. Inverse give you inverse of return what market is giving. So all those fancy products are also finding lot of traction because, as I said earlier, people have evolved from using simple market cap based products in core portfolio, which is very important, I must say, and started using these strategy based ETFs or thematic based ETFs from a tactical allocation or a tactical allocation point of view for a very short term horizon or a long term horizon on a case to case basis.
I'm sure you are now getting when you mentioned about all of those options. Uh, I actually think it will be good for you to lay out from an Indian investor perspective what are the different kind of ETFs or index strategies that one can think and consider. And the second part of factor investing is something that I'm really keen to touch upon. But maybe quickly, if you could just talk about the various different kind of ETFs and index strategies, and then we'll move on to dig deeper into the factor investing piece that you mentioned.
Yeah, so I think ETF market from a product offering point of view has evolved significantly. There are, I think, more than 180 ETFs in India right now, and as expected, majority of them are market cap centric. So you have uh, like Nifty 50, Sensex, which capture the most AUM or market share in ETF. Then you have obviously uh, mid cap ETFs, which are also getting popular as people see more and more a comparison between mid cap fund returns and benchmark returns. So a lot of MCAP based option. You have Nifty 100, Nifty mid cap 100, mid cap 50, etc. Then obviously if I moved, you have a lot of sectoral options also. Like bank ETFs are pretty popular, IT ETFs are pretty popular. You have ETFs on infrastructure, consumption, commodities, etc. Then you have ETFs on themes like ESG, manufacturing, again, several consumption based plays. Then you have ETFs on, as I mentioned, factor strategies like quality, momentum, low volatility, equal weighing, uh, etc. And then you have ETFs on silver and gold. You have ETFs on 10-year GSEC, 5-year GSEC. You have ETFs on target maturity funds. So there are a lot of products which are in offer on the passive side. And I think, as I mentioned, that people should first start with a simple market cap based ETF like an Nifty 50, have that experience, and then uh, look at their portfolio, see what is missing, or let's say if someone is very savvy and tracks market on a daily basis, and let's say from a tactical point of view wants to invest in IT right now, looking at a 6 month or 1 year position, why not Nifty IT ETF? Or someone is bullish on bank, why not bank ETF? So all those, I think, options are available on in ETF domain right now. So pretty exciting times if you are looking at domestic option. Internationally, also you have Hang Seng Tech, you have Nasdaq 100, Fang, etc. All those options available on the ETF platform.
Interesting. So options across equity, fixed income, commodity, and global. So that's a nice spectrum to pick from. Okay, I think let's move to factor investing. You introduced all the high flyers. Can you maybe talk about what factor investing actually is, and maybe one or two examples for people to understand what exactly does it do from a portfolio perspective?
Sure, and I think I'll try to keep it again as simple as possible. So I'll probably tell it how it happened in history, right? So there was active investing where active fund, and there is active investing where fund managers pick up stocks based on analysis, right? They analyze stocks and sectors, and based on certain parameters, they like or dislike stocks, and create those portfolio with set of stocks where they see opportunity from a short term and a long term point of view. Now, a lot of these parameters which are used by fund managers are very sorts of I think are very well known factors, and they can be quantified also. For example, a lot of fund managers look at quality parameter, right? They prefer companies which have robust profitability or stable profitability, good return on equity, low leverage, and this is something like quality. Some fund manager prefer low risk, less risky stocks, where they look at standard deviations, etc., and they prefer stocks which are more stable, less volatile. Then there are fund managers who prefer high dividend yielding stocks also. So they pick up stocks which give good dividend yield. Then there are some fund managers who prefer between two, if everything is same, uh, relatively smaller stocks than the larger stocks, because they feel that there is a significant run up which can have in the smaller sibling. And then there are people who does momentum investing, whichever is working right now will work in near future, so why not pick up stocks based on momentum? So I'm not saying that fund managers use only one parameter to select stocks, but they they may use one or multiple of these factors along with other parameters to create their portfolio. So this is a background on how these have worked on the active side. Now, when passive investing started, it was all boring, Shobit. It was all about S&P 500, Nasdaq 100, and let's say Nifty 50 in India, etc. And people got bored that why should I always invest in a portfolio where larger company gets larger weight, and it is all about market cap based investing. If I'm investing in India or in US, if I'm investing in banking sector, if I'm investing in mid cap and small cap, there also you are picking up stocks based on market cap, and larger stocks get larger weight. This is so boring. You're just giving me market beta. If by investing in companies which are by selecting companies based on market cap and weighing also based on market cap, you're just giving me beta. Whatever small cap is generating, you're giving me that. So why not create a passive product which gives a behavior which I want, or targets a risk profile or return or risk profile which I want. So suppose, Shobit, let's say you are a risk averse investor, and you're like, no, yeah, Nifty 100 is too risky for me. There are 20, 30 stocks which I am not comfortable with. I don't like Nifty 100. Can you create something different for me? And this is where factor investing came into existence, because by a lot of research, a lot of historical research, these factors were identified, like I have mentioned: quality, momentum, low vol, equal size, high dividend, etc. Growth and value can also be called as factor, which have worked over a long term horizon across different market cycles, which can be quantified, because passive investing, you need to have a set method to pick up stocks, rebalance it frequently, and create a portfolio, right? Which can be quantified and have exhibited certain risk and return profile. So, for example, a low volatility based portfolio, as and it is not complicated. जैसा नाम, जैसा देश वैसा भेस, उसी टाइप से जैसा नाम है वैसी परफॉर्मेंस है, या वैसे ही बिहेवियर है. A low vol portfolio, low vol smart beta index will capture stocks which are less volatile, and hence this portfolio will be more stable and tends to work better in a bear market. जब मार्केट 20% गिरता है, this typically falls less. That is the intent. A momentum based product will capture stocks which are doing well, and which have recent run up. So इस portfolio में as expected सारे भागने वाले घोड़े होंगे, and this will be churned on a frequent basis. This portfolio tends to do well in a bull market, and may or may not fall significantly more in bear market. Similarly, dividend yield will give you high dividend compared to market. Your quality-based portfolio will be more stable. Typically, during bear market, it will fall less, etc. So all these behaviors, all these factors have been identified, and then all these indices have been created. So when Shobit, you ask anyone that no, I don't like Nifty 100, give me a less risky. Then for you, a Nifty 100 low volatility 30 ETF will be very suitable because it consists of 30 stocks which are less volatile, hence the portfolio is less risky, and hence chances are, uh, more often than not, it will fall less than the market in any correction, and that is where your risk profile of the fund will be lower and your return to risk will improve. Whereas me, let's say if I'm a risk taking investor, I'll say our Nifty 100 is too safe. I want to invest in stocks which are doing well. My portfolio needs to deliver me more returns. I don't care about risk. So Alpha 30, Nifty 100 Alpha 30 will be more suited for me because their 30 stocks are selected based on their recent performance, weighted based on their recent performance instead of market cap. And hence, the portfolio is basically of stocks which are doing well, weighted based on their recent performance, and hence that portfolio is expected to do well during bull runs, may fall more during the bear phases, but I'm okay with that, right? I'm picking up higher risk in effort to generate higher returns. So that is what factor investing is all about. All these factors have been identified: quality, momentum, low vol, equal weighing, etc. And products have been created, and depending which behavior are you seeking or targeting, you can invest in those factors.
The way you explained it, Siddharth, it almost made me feel this is the chat GPT of the asset management industry. Long-term trends observed with behavior of specific factors and a quant model to tell us which factor works well in a particular type of hypothesis, and you're then overlaying it to build a portfolio. It is almost like machine working as a fund manager for you, and that's why that corollary. Uh, okay, I think maybe we will try to take one last point before we decide to wrap up. From a customer point of view, how does he decide which factor should he go for? Are there, like how you spoke about for ETFs, they were the low-hanging ones that start with a Nifty or start with a Sensex or start with a Nifty 100, etc., and then you can experiment with other ETFs, or similarly, you can start with a gold and you can start with a similar kind of an index in debt. In factor investing also, are there some easy starters that you can help users with? And of course, I'll share my favorites after that.
Okay, I think so. For example, if you look at the entire landscape, of smart beta investing in India. There are 50 funds right now with total AUM of 8,700 crores. And this is a growing space. I think in last 1 year, AUM grew by almost 30%. But I think the best thing, we are looking at data, and I think the best thing is that uh, two strategies with largest AUM are low volatility strategy and the momentum strategy. So two very contradictory strategy having the largest AUM, which just suggests that investors have already become very mature, because there are investors who are sorts of risk averse, or who are, let's say, taking a call that I do not want exposure towards such high volatility of the market, and I want to invest in low vol portfolio, Nifty 100 low vol 30 ETF or index fund or fund of fund. And then there are investors who are saying that no, I want more, and I want more through passive route. So I want to invest in momentum or alpha strategy, and I'm okay with higher risk if over a long run or in the bull run I'm able to significantly outperform the simple market cap based product. So that is very heartening to see. Uh, how should investor look at factor investing? I think I have mentioned it multiple times. First, it is very important for him or her to understand that these factors have a cyclicality. Quality and low vol typically works better in a bear market because it tends to fall less. It doesn't mean that they will underperform significantly in bull market, but typically their outperformance come in bear market. Similarly, alpha and momentum based fund tends to work very well in bull market and may or may not underperform in bear market. I think we are seeing a 50-50 performance in bear market. In the long run, so that is a cyclicality. Now, in the long run, typically we have seen alpha and momentum work well in India, because in India you have more bull cycles than bear phases, right? You are talking about a market which is expected to give you mid-teen returns, right? And that's why in the long run, momentum and alpha in India has worked well. Whereas in other geography, let's say Europe, probably I'll go with a low vol based strategy or a high dividend based strategy, because that seems to work better there. So you have to first identify, understand the cyclicality of those factors, and then probably uh, build your understanding there. Second, look at what your investment objective and risk profile is, and whether your investment objective aligns with the investment objective and risk profile of a concerned factor. If you're risk averse, you should not invest in alpha or momentum. If you want higher returns and you're okay with higher risk, you should not invest in low volatility, because your experience will be very different in both the product. Third very important point is, uh, always look where the factor is being created from, because as I mentioned that there are a lot of innovation which are happening in ETF and passive space. At times it can be confusing. For example, a Nifty 100 alpha 30 will pick up 30 best performing large cap stocks, whereas Nifty 200 alpha 30 can pick up 30 large cap and mid cap stock in any combination. It can be mid cap biased or large cap biased, and hence its performance will also depend how large and mid caps are doing, right? So be a bit cognizant about how the index is being created. I think it won't take much time. It is always better to be aware on how product is getting created. And then, as I mentioned, that if you want to start investing, obviously start with Nifty 50, etc. While going into factor, pick up the factor which aligns with your risk profile and investment objective. Start with a smaller allocation if you are not confident. Start with allocation in your satellite portfolio. And once you get a feel of it, then you can build onto it.
I think that's quite well summarized, Siddharth. Thank you for that. And since I promised, I think When I was running a similar kind of a fund strategy for our investors, we found a lot of merit in having allocations to Nifty 50 as a base index as a substitute for large caps for some part of our allocation, and we really thought a combination of low volatility and momentum gave a good balance. As you rightly said, low volatility would protect the portfolio on the way down, and momentum would give it the right push when markets really start to drive faster. So that's how we looked at it. But I think this has been super helpful and insightful, if I can say. Thank you so much, Siddharth. I think users would have got reasonably good clarity of how this whole space of ETFs and index investing is evolving. And we look forward to seeing you in many of our future conversations.
Yeah, thank you so much, Shobit, for having me here. And I hope that I was able to clarify a few things about ETF and factor investing.
Great. All right. Thank you. See you soon. Bye bye.